U.S. price floor is coming. Vice President J.D. Vance has just issued a statement that upends what much of the business world believe about how commodity markets function. A government-backed minimum price for critical minerals, with silver explicitly included. Reuters confirmed the development on Wednesday. But there's more beneath the surface that wasn't highlighted. In Shanghai, silver is already trading at a 19% premium compared to Western markets, roughly $16 above what New York pricing reflects. The pattern is hard to ignore. Physical buyers accumulate metal overnight. Paper traders unload positions during U.S. trading hours. The $90 level has now been tested twice and rejected twice. Someone clearly does not want that price to stick. But the real question isn't whether silver will become expensive. It's what happens when a government decides commodity is no longer allowed to be cheap. Welcome to the dullest currency on earth. Before we go any further, before what may be the most important economic briefing you'll hear this quarter, let me ask you something. The way your grandfather might have asked you to hand him the newspaper on a quiet Sunday morning. Would you consider subscribing to this channel? I know everyone asks for subscriptions now, but think about it this way. We're not here to entertain. We're here to inform, the way serious economic analysis used to be delivered before everything turned into noise. If you value signal over spectacle, data over drama, then subscribing is like keeping a dependable financial journal on your desk. One more thing. Leave a comment and tell us where you're watching from. North America? Europe? Asia? Or perhaps somewhere operating in a completely different time zone. It matters because this policy shift isn't regional. It affects anyone, anywhere, whose operations depend on strategic commodities. Now, let's continue. On what most professionals would have considered an ordinary Wednesday, Vice President J.D. Vance addressed representatives from over 50 nations. Officially, the meeting was about access to critical minerals. But what he announced altered the foundation of commodity markets. The United States will implement a price floor system for critical minerals. Reuters verified the announcement within hours. Silver, designated a critical mineral, was included. For those unfamiliar with the concept, a price floor is not a recommendation. It's not guidance. It is a legally enforced minimum price below which a commodity cannot trade. It is direct state intervention in a market once considered free. The last time the U.S. imposed price floors on strategic resources at this scale was during wartime. That matters. Governments don't interfere with commodity pricing casually. They do it when national security collides with supply chain fragility, when the cost of doing nothing becomes greater than the cost of distorting markets, when they can no longer risk leaving essential materials, those tied to defense, infrastructure, and technological independence, at the mercy of market forces. So what does this mean for silver? The metal is sitting at a critical inflection point. Western spot prices hover near $86 per ounce at the time of this recording, but that figure tells only part of the story. In Shanghai, silver trades closer to $102 per ounce, a $16 premium, roughly 19% above Western prices. This isn't market noise. It isn't a fleeting arbitrage gap that clever traders will erase. It's a structural split, signaling deep imbalance between physical demand and paper pricing. Recent trading behavior reinforces this view. During Asian and European sessions, silver prices climb as physical buyers accumulate supply. Then New York opens and heavy selling emerges. Prices reverse sharply. On Monday, silver touched $90 before falling to $83 within hours. Tuesday repeated the pattern. Another push toward $90. Another abrupt rejection. That level has become a ceiling the market repeatedly tests but cannot hold, and the selling pressure appears at the same time every day, during U.S. trading hours. This is not coincidence. Overnight demand reflects real metal changing hands. Daytime selling reflects derivatives leverage and paper exposure. For decades, these two markets largely moved together. Small physical premiums were normal, but 19% premium in Shanghai, while New York struggles to sustain $90 is not normal. It's a fracture. Now inject a government-imposed price floor into this fractured system. The consequences are immediate. A price floor ignores technical resistance. It disregards algorithmic sell programs. It exists to protect domestic production. Because here's what many market participants misunderstand about mining economics. Mines do not operate indefinitely at a loss. When prices fall below extraction costs, mines shut down, exploration halts, capital flees, and once production capacity is lost, it does not come back quickly. Restarting a mine takes years. Developing a new deposit takes even longer. The U.S. government appears to have concluded it cannot accept that risk. It cannot allow domestic silver production to collapse because paper markets suppress prices below sustainable levels. It cannot rely on foreign suppliers for a metal deemed critical to national security. So it draws a line, a minimum price below which silver will not be allowed to fall. This is not a forecast of where prices will go. It is a declaration of where they will not be permitted to go. And that difference between market-driven discovery and policy-backed protection changes everything. The era of cheap silver effectively ends the moment a government guarantees miners a minimum price regardless of paper market behavior. What follows is adjustment. Adjustment by manufacturers facing higher input costs. Adjustment by mining companies whose project economics just changed overnight. Adjustment by financial markets built on assumptions that no longer apply. The announcement came Wednesday. The ripple effects will unfold over months and years. But the structural shift happened the moment those words were spoken. Price floor, critical minerals, silver included. Everything after that is consequence. There's a number that keeps mining executives awake at night. $28. That was the average break-even price for primary silver mines back in 2019. Today, it's closer to $35 for most operations. Marginal mines often need $40 just to survive. The most complex, low-grade deposits require $50 or more. So when people talk about cheap silver, they should understand what that really means. Prices near or below production cost. Mines operating with razor-thin margins. Deferred maintenance. Canceled exploration. Delayed investment. For 20 years, the world assumed silver would always be plentiful and affordable. That assumption is collapsing, not because of hype, but because of math, geology, and geopolitics. The vice president's announcement didn't create a crisis. It acknowledged one already in motion. Global mine supply has been flat since 2016. Industrial demand has risen every year. Solar panels alone consume over 100 million ounces annually. Electronics, medical equipment, water purification, automotive sensors. The applications keep growing. Meanwhile, major new silver discoveries have become rare. The last significant primary deposit entered production nearly a decade ago. Geology sets limits. Ore grades are declining everywhere. What once yielded 12 ounces per ton now yields 6. That means more rock, more energy, more labor, higher costs. This isn't cyclical. It's depletion. Layered geopolitics on top. China controls roughly 60% of global silver refining capacity. Concentrate mined in Peru is often refined in China before reaching world markets. That worked when supply chains prioritized efficiency over security. That era is over. What happens if access to that refining capacity is restricted? If trade disputes escalate? If strategic materials become leverage? These are no longer hypothetical. They're active national security assessments. Silver's role extends far beyond jewelry or coins. It's the best electrical conductor, the most reflective metal, naturally antimicrobial. It's embedded in radar systems, missile guidance, communications gear, night vision, and military medical equipment. The Department of Defense cannot tolerate unreliable access to silver. Then there's renewable energy. Every solar panel requires around 20 grams of silver. 1 gigawatt capacity consumes roughly 1 million ounces. Planned expansion requires billions of ounces. If domestic mining collapses, that metal doesn't magically appear. You can't print silver. You have to mine and refine it. This is the logic behind the price floor. The government has decided that cheap silver is a greater risk than market distortion. Securing production capacity matters more than preserving the illusion of free pricing. The announcement didn't invent a new reality. It recognized the one already here. There are 2 silver markets. Most investors think there's only one. They're wrong. In New York, thousands of ounces can be sold with keystrokes. No metal moves, no vault opens, just contracts and cash settlement. That's the paper market. In Shanghai, manufacturers need actual bars delivered, tested, insured, and shipped. That's the physical market. They price the same metal, but not the same way, and the gap between them is widening. COMEX futures allow extreme leverage. Most contracts never result in delivery. They're bets, not allocations. Physical buyers, on the other hand, need metal now. They can't roll positions forward. They pay premiums for certainty. That $16 spread is the price of knowing the silver exists. Recent trading makes this obvious. Overnight rallies driven by physical demand. Daytime sell-offs driven by algorithms. No metal changes hands in those drops. Just leverage unwinding. Paper markets can create infinite supply. Physical markets cannot. Inventories are falling. Registered COMEX silver sits near multi-year lows. Shanghai and Indian premiums stay elevated. European buyers report longer delivery times. These are supply constraints meeting inelastic demand. Now at a government-backed price floor. A physical buyer of last resort with unlimited capital. If paper markets try to push prices below the floor, physical arbitrage appears instantly. Deliver metal. Sell to the government. Lock in profit. Paper prices cannot sustainably trade below a sovereign back floor. That's why this changes everything. The old equilibrium, paper in the West, physical in the East, assumed free market dynamics. That assumption just died. Now there's a third actor, the U.S. government. What comes next is repricing, restructuring, and possibly delivery failures that expose how much paper exists relative to physical metal. The market is being warned. Businesses must adapt now. The window between announcement and implementation is critical. Those who act early, securing supply, building inventory, renegotiating contracts, gain advantages at last year's. Those who wait will pay more for less certainty. This isn't about predicting $100 or $150 silver. It's about recognizing that the rules governing strategic commodities have fundamentally changed. Governments are no longer observers. They are participants. And when that happens, markets and businesses must adjust.